So welcome everyone. For those of you who I don't know, my name is Kathy Murphy and I'm the Executive Director of ICAN, also known as the Irish Canadian Immigration Centre. Happy New Year to you all. It seems strange to say Happy New Year. I know we have another tough year ahead. What I have been saying to people is that I wish you a hope-filled new year, and it seems to be landing. So I wish that for all of you. We thought that we would kick off 2021 with a series of financial literacy webinars and lots of information on tax season and taxes under COVID times. So if you follow us throughout January, you'll get lots of information on your own personal finances and on what to prepare for in terms of tax season. Tonight, I think, is probably going to be the most useful for everyone. And this is a webinar on financial literacy basics in Canada. And our guest tonight is Daniel from Windmill Micro Lending. I did a podcast with Windmill back in the fall that you might have heard on getting accredited in Canada. And it was absolutely fantastic. And our guest was wonderful and I learned a ton. So I expect that I'm going to learn a ton tonight too, and I hope that you all will. I will turn it over to Daniel, and just to let you know that there will be a Q&A at the end, so feel free to ask your questions when you unmute or to put them in the chat function. So Daniel, I'll turn it over to you.
Great, thank you, Kathy. As mentioned, my name is Daniel Baudin-Hall. I'm the Community Relations Specialist at Windmill Microlending. So tonight we're going to be covering the basics of the Canadian credit system, covering what is credit, as well as a few budgeting basics for you all. I hope that it's all going to be information that is of use to you. As mentioned again, we will be having a Q&A session at the end. So if you have any questions, you're more than welcome just to type them into the chat box. We will go through that towards the end, and I'll do my best to answer any of those questions. Before we hop in, a little bit about myself. My name is Daniel. I work at Windmill Microlending. We're a nonprofit registered charity that specializes in helping internationally trained professionals become accredited in their field. I'm also, as part of that job description, I'm a trained financial literacy facilitator. So I was fortunate enough to take a training program with Prosper Canada. Prosper Canada is Canada's largest national charity dedicated to expanding economic opportunity for Canadians living in poverty through programs and policy information. So basically, I was able to participate in a training session in order to provide sessions such as the one I'm going to be doing tonight. And it's a big thanks to them, as a lot of the material that this presentation is based on comes from their resources, and they're a great resource just in general for anyone who might be wondering about, or who might want to get a little bit more information from them. They have budget templates, they have calculators, they have a lot more in-depth content than that what we're going to cover tonight. But the general idea is just to get a basic overview of credit. What is it? How can it apply to you? And what tool it is, and how you can help, how it can help you in your Canadian journey. So what we're going to be covering tonight. So again, basics of credit. So what is credit? Some examples of credit, how it applies to you in your life. We'll also be covering Canadian credit reports. So we'll be covering Canadian credit records, your credit score, how they come up with that number, and why it's important for you to maintain a good credit history, a clean credit report, and have a high credit score if possible. Finally, we'll be wrapping it up with some budgeting basics. So we'll be covering the general idea behind budgeting, why it's important to you again, as well as a few ideas on how you can prepare your own budget. And I'll cover it when I get there, but I do recommend that you find a budget template somewhere on the web. Excel has one built into the program, but there's also plenty of templates from great sources that can help you get a handle of how much money you're making, how much money you're spending, and how to rein in those expenses that might not be the most appropriate use of your funds if that's something that's a goal of yours. So let's start off with what is credit. So just in general, credit basically means that you receive a good, a service, or financial amount, so money, right now, and you're going to pay for it later. So that means you're basically going to take possession of it now. That can be a piece of furniture, that can be a home if you're going to be taking a mortgage, or it can be access to capital, so money, that you can spend and then you're going to pay for it at a later date. It can also be considered basically a promise to repay, an agreement or a contract. So you're basically making an agreement with another party. Usually they're called the lender or creditor, that's providing you, again, with that financial amount, that that good that you want to take possession of now, you want to utilize it now. However, you're going to have to pay it back in the future, and you agree with that lender on the terms of which you're going to repay it. The lender, as I mentioned, is also known as a creditor. They basically decide whether or not they're going to provide credit to you. So it's not a right to obtain credit by any means. It's basically if the lender believes that you're in the position to repay the amount or repay the value of the good that you receive, they will then agree to provide it to you, and then again, you'll pay it back later. That'll be a trend throughout this presentation, is making sure that the idea that credit is something you will have to repay. It's going to be repeated a few times because it's really important to grasp that whether it's something that you receive now and you're going to pay later, or if it's a credit card, if it's a loan, a line of credit, anything like that, you're going to have to pay it back. So it's really smart to use it to your advantage as opposed to becoming sort of trapped within that tool. And finally, credit is a very useful tool, as I mentioned, to manage your money effectively. But again, if you overuse it or you don't understand how it works, you can find yourself in serious trouble. I'm sure that everyone's heard of the sort of worst case scenarios where people find themselves in significant debt. And it is a really hard hole to dig yourself out of. So the best offense is a good defense in this case, and making sure that you know what it is and how to avoid the pitfalls of credit that's readily available to you in Canada. So let's go through some of the pros and cons of credit. So one of the pros is it's convenient. If you think about a credit card as one example, you don't have to carry around cash at all times. So if you're able to just tap, that's something that's really convenient. If you have a Visa or MasterCard that allows you to tap for purchases, it's great during COVID because you don't actually have to touch the PIN pad or anything like that. So in general, if you have access to credit, it is a very convenient tool to have in your on your tool belt in order to go about your life. It's safer than carrying cash. So if someone, if you lose your wallet, for example, you can just quickly call your credit card company and cancel it. They'll send you a new one, and you don't have to worry about the actual value of the money available to you being lost. So for example, if you lose $200 in cash, unless you find a good Samaritan who brings it back to you, you're out $200. Whereas if you have a credit card with $1,000 limit, if you lose that, if you're quick enough and no one commits fraud, then there's no chance of that $1,000 being spent on something that you obviously do not authorize. It's great for emergency money. So for example, if you have a car and it breaks down, well, you might not have the $500 to do a brake fixing job, for example. So you can basically pay for it on credit and incorporate that into your budget and make sure that you pay it off as soon as possible. Other pros of it are that most credit cards offer either rewards points, air miles, or cash back. So there are benefits in terms of how you use a credit card. But again, you have to maintain good kind of habits and make sure that you're paying off your credit card as quickly as possible. You can also use it to track purchases. So many of the banks now and credit card companies offer tools that allow you to track where you're spending your money. They are already divided up into categories. So for example, how much you're spending on groceries every month, how much you're spending on transportation, all that. So it's a really good way to keep track of your purchases as opposed to keeping let's say a physical notebook of all the purchases you're making on a daily basis so that you know how much you're spending on what. It's also essential for buying goods online. So again, during the pandemic, a lot of shopping has been moved online. And there's no way that I know of that you can buy something online, whether that's from Loblaws or Amazon, anything like that, without a credit card online. You can't pay cash, you can't mail them the cash, of course, you can't send checks. A credit card or another method of credit is also the only way you can pay for those. It's also important that you build a Canadian credit history and you receive lower rates on your credit due to that credit history. So as you use credit, you basically establish a history and you're showing that you're able to be responsible with it and you're able to repay the money that you're borrowing and that you're using on credit. And with that, it shows to other lenders in the future that you're a good steward of the money that they're giving you access to. And from there, they can reward you by giving you a lower interest rate, or you can access even more for example, a mortgage or a car loan. And finally, you can pay for large expenses. As I just mentioned, a home or a car loan, your education, all of those things can be, credit is a good tool for those costs. because most people don't, say for example, you're thinking about buying a home, most people aren't able to actually save up $500,000 before they actually purchase a home. So it's a good way to buy large expenses that you know you're going to pay off in the long run, that are providing value to you at the immediate time, and in some cases actually allow you to build an investment for yourself. Some of the cons, however, because every tool is has pros and cons, it can be hard to understand the terms and conditions. So they all come with long lists of terms and conditions that you're required to read before you agree to it. And some of those can be a little bit confusing for some people. There's temptation to overspend. So you might have access to $1,000 and you might want to spend a full $1,000 on your credit card. That's not a great thing, but it is something that happens to people. There's interest charged to all the purchases that you make on credit. So with that means that something that you buy for, say, $100 can end up costing $120 or even more in the long run. Part of your monthly budget goes to paying your debts. So if you use your credit irresponsibly and you have a large amount of debt, or if something happens, life happens, right? So if something happens and you're not able to pay off your debts, that means that down the road, a portion of your budget's going to have to go towards paying off your debts. There's the potential for fraud or identity theft. There's late payments that can lead to a bad credit history. So if you're not making your payments or you forget, that can have a negative impact on your future. There's bad credit histories that limit those options. So if you have a bad credit history, you're not going to be able to apply for a mortgage. You might get one, or a car loan, for example, but the interest rate might be higher than you're willing to pay. And finally, if you're unable to pay and unable to come to an understanding with the lender, your file might be sent to collections, which adds another cost to it, and it's a very stressful experience. So we're going to talk about a little bit of the different types of credit. So there's two types of credit. There's revolving credit, and there's installment credit and loans. Revolving credit basically means that you're pre-approved for a certain amount of money, say $1,000, that you can access at any time. Say you borrow that full $1,000 and you pay it back. If it's a revolving credit option, basically you're able to you can reuse that money over and over again as long as you pay it back. Whereas an installment loan that we'll cover in a second is more so that you're approved for a certain amount of money for a certain purchase that you have to pay over a longer term, and that you're not able to re-access unless you apply again for that amount of money. So types of credit include credit cards, retail store cards, overdraft protection, lines of credits. So all of these things is basically you have access to a certain amount, and from there you're going to be able to use it, repay it, and then reuse it again. There's different conditions and uses for all of these different things. Credit cards and lines of credit are probably going to be the most applicable to the group today. So credit cards can be used to pay for almost anything. You can buy in stores, you can pay bills with it, you can rent products, you can buy online, anything like that. Usually they come with a minimum payment. So every month you're going to be given a statement, and you're going to make the minimum payment on that every month, unless or otherwise it counts as a missed payment. The interest rates vary, but they're typically around 20%, which can be quite high if you're using it to basically pay for something that you're not going to be able to pay off immediately. Lines of credit are similar. They're used to make purchases. They're typically tied to your bank account or your debit card, for example. And basically you'll be given, it's similar to a credit card. You're given a credit limit with a minimum payment, and the interest rates vary depending on the situation you find yourself in, your credit history, whether it's a secured line of credit or unsecured. So basically the difference between those two is unsecured is you're just promising to a financial institution that you'll repay this amount. A secured line of credit means that you're using some asset that you already own. That can be your house, that can be your car, that can be some investments that you have, and you're basically making a deal with the financial institution that if you do not repay the amount that you borrow through your line of credit, then the financial institution can basically claim those assets that you put up on the table as repayment in place of the amount you owe them. Installment rate or installment credit / loans, as I mentioned, you're approved for a certain amount of money for a certain purchase or expense. So there's a number of different types of installment credit, including payday loans, buy now, pay later loans, consumer loans, mortgages, student loans. I'll touch on payday loans just because they might be something that many of you are familiar with, or you might find yourself familiar with in the future. Basically, they're for short-term cash needs. So if you are, say, a week before your next payday and you don't have a credit card or you're maxed out elsewhere, and you're looking to obtain some amount of cash that you can get through that next week, payday loans do exist as an option. However, the amount is based on your income because they expect for you to pay back that amount immediately upon your next pay date or within a month. There's very high fees associated to that. I've seen interest rates ranging from 50% to 100%, meaning that you're actually going to have to repay double the amount you borrowed. So if possible, I would recommend that you avoid payday loans. They're not the most reputable institutions for the most part. There are some organizations that offer them, but in general, you're going to be paying a high fee. You're going to have to pay it back pretty quickly, and it usually isn't the best option for a lot of people if you have other options. Other than that, mortgages are pretty straightforward. So it's for a home or a property. It requires that you provide either, well, between 5 to 20% of the amount you plan on paying for that home or property out of your own savings or from other means. Usually you're going to be paying that amount. Well, you receive the lump sum and then you're expected to repay that amount over the next 25 to 30 years. The terms of the agreement, so basically like the interest rate, are going to be set at variable terms from between 1 and 5 years, depending again on what makes the most sense to you and what's available to you based on your financial situation. Student loans as well, if you're looking at trying to return to school, if you're looking at paying for the program fees, books, or living expenses, you can apply to banks as well as there's government programs out there to help pay for schooling. There's usually a low interest rate associated to that. Sometimes you won't have to pay the interest during your time of study, and usually the repayment starts once you finish your studies and ideally are back in the workforce. So what are some tips on managing your credit and making sure that you are making the most out of it without becoming basically trapped in a debt hole? The best things I can tell you to avoid are to avoid treating credit like it's free money, because it can easily become very expensive money. So I knew quite a few people in university who sort of approached it like that. They got a line of credit for their studies, and to them it was, I have $5,000 to spend on whatever I want. So you can imagine TVs came out of nowhere, gaming consoles, all the things that young men usually spend their money on when they're first away from home. But they're in for a rude awakening when the bill comes due and they realize that, well, they might have a TV and a game console, but now they owe $5,000 to the bank or to the government, and they're pretty good at getting their money back. Other things I can recommend you avoid is to avoid maxing out your credit. So just because you're able to access up to $1,000, for example, on your credit card, doesn't mean you should be using your credit card up until that maximum $1,000. There's a number of reasons for that. One is that it might be challenging for you to repay that amount in full on a monthly basis or whenever that credit comes due, but mainly because it also impacts your credit report. We'll touch on that in a second. However, if you're using almost the maximum amount of your credit, that reflects poorly on your credit report, and your credit score can be affected and be negatively affected by that decision. And I also avoid missing payments at all costs. So even if you can't pay it off all in full, always make your minimum payments, because otherwise those are recorded and again can have a long-lasting impact on your credit history. The best practices I can recommend to you is to only use as much credit as you can afford to pay back when it's due. So if you have a credit card, I'd recommend only spending on your credit card what you know you're going to be able to pay back that month, because otherwise you'll be basically paying that 20% interest on that loan going forward until you do pay that money back. If you're looking at a larger loan, so for a car or for a mortgage, for example, I'd recommend you shop around for your lowest interest rate, because it might not be that much. It might be just a decimal point difference, but if it's a long-term investment or a long-term loan, then that can add up to hundreds or thousands of dollars over the long term. Also, again, understand the loan agreement. So make sure that you know how much interest you're being charged and when you need to make the payments and every other criteria that's listed on that document before you sign it. I'd also recommend that you determine the full price, the full cost of your purchase before you actually buy it. So you might be thinking it's only $100, but if you're being charged interest on that over the next year, that can easily add up to $120. Or again, if you're not paying it off quicker than that, it can accumulate, and even the amount of interest you pay could even surpass the original cost of the item. And finally, again, pay your balance in full at every month if you can. I've said that twice because it's really important. You do not want to you don't want to carry a balance if at all possible. Again, people are in different situations. However, if possible, do your best to avoid carrying a balance on any of these credit options, because again, you're going to be paying interest on it, and it will increase the overall cost of the good or service that you purchased with it over the long run. So what is a credit report? One of the great things that Prosper Canada came up with was actually comparing your credit report to your report card at school. So basically there's two credit unions in Canada. There's TransUnion and Equifax. You can think of these as the schools. You're going to receive a credit report, which you can think of being as your your report card, pardon me. So basically what grade you got in all the different subjects. Even further than that, for each of those credit options you have, you're going to receive a credit rating for each of those. So if you have a line of credit, a credit card, and a mortgage, each of those will receive a credit rating based on your behavior with that credit option. So you can think about that as the specific grades you got in, say, history or math or science, anything like that. And finally, your credit score is what can be considered your GPA. So how are you doing on average based on all those other criteria? Who can access your credit score? So lenders can, of course, access your credit report. The reason for that is that if they're looking at who to lend money to, they need to know what your past behavior was like and how you were able to manage your credit in the past to make sure that you're going to be able to be a responsible borrower going forward. Landlords may also ask for your credit report to determine whether or not you're going to be likely to pay rent. Insurance may ask for it to make sure, again, that your premiums are adjusted based on your credit history and making sure that you are usually paying your bills and paying off your debts as quickly as possible. Other times, employers may ask for it. Usually, I haven't come across too many employers that request your credit history, but I do know that they ask for it in sensitive jobs in the government, for example, because they need to know if you're in debt, that can be used as leverage by other people. So if you're having access to top secrets of the government, they don't want you to be in debt. That can then be used to manipulate you or convince you to give them the information that you have. So let's go into a little bit of detail on what's on your actual report. So the first segment you're going to see is your personal information. So that's your name, address, any previous addresses you have, your birth date, your SIN, and your past employers. The second portion is going to be inquiries. So basically all people and companies who have requested a copy of your report, every time someone asks for your credit report, that's not you, that shows up on your credit report. So basically every time someone asks for it, they're going to be listed there because they need to make sure that they're keeping track of all the times you are looking for credit somewhere, as that does come into play when they're determining your score. There's also account information. So again, this lists all the information all the information of all the existing credit that you have as of right now. So that can be your credit cards, your loans, your lines of credit, any mortgages. That'll also include the name of your creditor. So which bank, for example, you have a mortgage with, the account number, the balance owed, the credit limit, and the rating on your account. Following that, they're going to have your banking information. So it's just the information on any bank accounts you have, as well as a notice of whether or not there's any not sufficient funds or bounced checks. So that's in the case where you have a pre-authorized payment on your account. But if there isn't enough money in the account to make that payment, that can result in a non-sufficient funds or not sufficient funds notice, which basically means that you weren't, it can show to possible lenders that you weren't managing the money in your accounts very well, and that can have a negative effect, again, on whether or not a lender will lend you more money. There's also public information. So if any of your accounts have gone to collections, or if you declare bankruptcy at all, that will show there again. for up to, I believe, 6 years, after which it will be removed. But again, those are pretty serious instances where you weren't able to make your payments, but even more so than that, you weren't able to come to an agreement with the lender, and it ended up being sent to either a collections agency, or you had to declare bankruptcy, which basically means you go into consumer protection, meaning that you're going to court in order to determine how much money you're going to actually have to pay back out of the balance that you owe. So again, all this information really does come into play when lenders are assessing whether or not you'll be able to access their money, because their goal is to make sure that you're going to repay their funds and that they'll make money on the interest if possible. But their main goal is to make sure that they're lending to trustworthy, reputable people that, based on past information that they have access to, will repay the money they borrow. You are also able to include a consumer statement. So that's your own statement on why there might be some information on your credit report. So for example, if you were sick or if you were unemployed due to a recession, for example, COVID might be an example. If there's anything on your credit report that you think you want to add context to, you are welcome to send in a consumer statement to the credit bureaus, and they'll post it there. And hopefully that'll be able to sway the opinions of any lenders to have faith in you if that's the situation. So your credit score, what is your credit score? Basically, your credit score is a score between 300 and 900 that credit bureaus use to rate the information in your credit report. So based on all that information I just mentioned, they're going to use that to determine what your score is, which is the easiest way for a lender to look at whether or not they'll approve you for a loan. So while the numbers are between 300 and 900, typically 650 is going to be the minimum that banks require for providing loans or lines of credit or anything like that. And even then, if you are around the 650 mark, they might end up charging you more interest because in their eyes, you're a riskier candidate for that credit. Which again is why all that I was mentioning earlier in terms of paying your fees on time, making sure that you're paying off your credit card at every time as possible. Those are really important because they end up affecting your future credit options and what interest rate you'll pay on it. So many people have questions about how they come up with those scores. They are computer generated, and there is a mathematical formula to it. So it's not just a random number that they're pulling out of nowhere. It's based on 5 main factors, which include payment history. That's the largest piece of the pie, let's say on the right there, which accounts for 35% of how they determine your number, your credit score, pardon me. The second largest is your amounts owed. The third is your length of credit history. The fourth is your new credit and inquiries. And the fifth is the types of credit. So basically, payment history is, do you have a history of making your payments on time? That's really important for obvious reasons if someone's considering whether or not to lend money to you. The amounts owed is also important because they want to make sure that you have, that if you do have debts, that you have the income to make sure that you'll be able to make your payments on those existing debts, as well as the new debt that you'll be incurring with that loan or credit card that you're applying for. The length of your credit history is also important because they want to make sure that you have, they want to see that you have a credit card that you've used for a couple of years, for example, so that they have a longer sort of snapshot of your behavior, which reduces the risk for the organization lending you the money. If they can see that over 5 years you paid your credit card every month, as opposed to if they only have 2 months of you paying your credit card, the 5-year mark or the 5-year option is preferable because it shows sort of a consistency in your behavior. The new credit and inquiries is something that not many people know about, but it's important to keep an eye on. If you're applying for a lot of different credit, if you're applying for credit from different places, every time you apply for credit, they'll pull your credit report, and then again, that inquiry is added to your report. So I have some personal experience in that. I did not know that when I was younger, and I applied for a credit card at a few different places when I was in university, and it actually ended up, it sort of had a negatively reinforcing circle because I would apply, they wouldn't approve it, and I would apply somewhere else, and then they would look back at my new report showing that I had already applied and was declined, And then it sort of just kept happening. So that wasn't a great situation to find yourself in. But, you know, we all learn. And so yeah, that's a good piece to remind yourself of is if you're going to be applying for credit, only apply when you really need it and apply only to one bank if possible. And finally, the types of credit. So they want to see a mix of different options. So they want to see that you have a credit card, that you have a line of credit, for example, and possibly a mortgage or a car loan, so that they can see that your behavior is consistent across different credit options that you have. Other effects or other factors that will affect your score. So if you've had accounts or turned over to collections, or if you've filed bankruptcy, those can really negatively affect your credit score. So again, ideally you would avoid those two situations if you are hoping to have a great credit score and you have the means to do so. So some tips on how to improve your score. So the first suggestion, again, is pay your bills on time. So that can be your phone bill, that can be your hydro bill, your internet bill, any bill you have. The best thing you could do, a good best practice, is to pay that as soon as possible and on time. If you can't pay your bills, that's okay, but you should take some action. So what that means is basically contact your creditor and ask to work something out so that does not go on your credit report. So if you're not able to pay back your loan, if you're not able to make your minimum payment, I do recommend you give them a call, because they'll usually be pretty receptive if you're reaching out to them. They're used to dealing with people that are trying to avoid them, because naturally if you owe money to someone and you're not able to pay it, most people shy away from that. But if you're upfront, if you call them, if you talk to them, it's not guaranteed that they'll say move it back a month or anything like that. But it's better to try that and not receive it than to not receive it whatsoever and not try, because it ends up being the same. And if they do accept your, reasoning, or they want to make a deal with you, then they can, and that avoids that negative impact on your credit score. Try to pay your credit card balance in full. So again, don't spend anything on your credit card if you can't pay it off at the end of the month. Pay off your debt as fast as possible. Stay within your credit limit. So while you might be, again, eligible for up to $5,000, try not to exceed that. Sometimes large payments can exceed that all in one go. And it's best to avoid exceeding it, because then, again, that can really negatively affect your credit score. Don't apply for credit too often, so don't be a younger Daniel. Use your credit, but use it wisely. So you do have to use your credit in order for it to sort of build your credit history. So if you just have a credit card that's sort of sitting in a drawer that's not being used, that actually doesn't do anything for your credit profile, because they're not actually seeing any payments that you're being made, or you're not using it and you're not paying it off. So it doesn't actually affect it positively. It just doesn't do anything really. So the best thing I can recommend is use your credit, but use it only when you need to, and make sure, again, that you're spending within your means if possible, and that you're paying it off as best as you can. And finally, it's a good best practice is to request your credit report from the two large credit bureaus, so Equifax and TransUnion. You are entitled to, I believe, 2 free requests every year. So they have it on their website. It might be a little bit hard to find. They might be trying to sell you a service to access your credit history. But what I can guarantee is that you are entitled to 2 reports every year for free. So if you go to either of their websites, you'll be able to eventually find the option to get your free report sent to you. When you receive that, go through it line by line. Make sure that every single piece of information on there is accurate, because if it's not accurate, you need to get that addressed and fixed as quickly as possible, because there are situations where someone else's credit history is put on your credit file because you have a similar name, or your birthdays are similar or something like that. So I do recommend that everyone, if possible, that they request their credit report from one of the bureaus, and that they look through it, make sure that there's no errors, and then you're checking it regularly if possible. So every 6 months, if you can, request your credit history from one of the bureaus, look through it, make sure that there's no mistakes. So moving on to budgets. So simply put, a budget is basically just a way to keep track of your money. So how much money am I receiving? How much money am I making every month? So your income, and how much money are you spending every month, your expenses. It's also a good tool to show how much money you actually have, how much money you might need for a vacation or some sort of expense down the road, and what you actually spend your money on. That last piece is really important because especially if you have a credit card and tap is an option, you might be spending money here and there that you're not thinking are big purchases, like say you go to McDonald's for breakfast or something, you end up spending $5 or $10, and you're doing that every day, or you're buying coffees here and there, or any sort of small expenses. If you're doing them regularly, they can add up to a larger amount than you'd expect at the end of the year, or at the end of the month, pardon me. So keeping track of that is a good way to remind yourself that if you have a goal down the line, say it's to buy a new car or to save for a vacation, you can sort of chip away at those smaller expenses on a daily basis, which will lead to larger sums of money in the long run. And finally, creating and maintaining a budget can actually help you manage your money, can plan for the future and accomplish your goals. So if you want to go back to school, if you want to, again, buy something, if you want to start saving for retirement, anything like that, having a budget is a great way to start and to make sure that you get a little bit more control over your own expenses. So again, why should you budget? You're more aware of what you spend money on. You find areas that you can spend less money and save. You take control of your finances and feel more confident. So again, a little story from my background. When I wasn't paying attention to my budget, it was pretty easy to feel a little bit unconfident and not know exactly, well, uncertainty breeds inconfidence, I believe. So having a good idea of what you're spending your money on does give you a lot more of a sense of security, and you know what you're able to buy and what you're not able to buy when you do become more experienced at budgeting. It also allows you to make sure that you pay your bills on time and avoid late fees. So you know you have the money available to pay for your internet bill that's coming in a week, your phone bill in 2 weeks, all of that. If you have a budget, you're able to know that you have already allocated money to cover that expense down the road. Another example would be to reduce or pay off your debts. It reduces your money-related stress. It lets you save for long-term goals. So going on vacation, as I mentioned, paying for school, buying a house, or saving for retirement. And you have more money to spend on the things that are important to you. So again, if you're looking at your budget and you're seeing that you go to McDonald's every morning, I'm using the same examples a lot because I hope that they're as relevant to you as possible. But again, the same ideas can be applied across the board. But if you're spending $10 a morning on breakfast, for example, and you notice that adds up to $50 every week, $200 every month, you might want to say, well, I prefer to spend that $200 on a new pair of hiking shoes or a new bike after a few months of saving that. It really depends, but it gives you a lot more control. And again, it allows you to decide what you're going to be spending your money on. And you can achieve your goals a lot quicker when you have a plan, as opposed to sort of wandering aimlessly around money topics. So let's cover some of the income sources. We'll get to basically the idea of how to create a budget in a second, but the first point is to basically identify all of your income sources. So where and from where is money coming into your bank account, or are you getting paid on a regular basis? So the first most sort of universal option is your paycheck. So from work, are you getting paid on a weekly, bi-weekly, or semi-monthly, even monthly sometimes basis? But for most people, a paycheck is where the majority of their income is going to come. Other times, if you're an entrepreneur, you might have self-employed business income. If you have a sort of side hustle at home, you might have home-based business sales of homemade products or services. If you're working in the service industry, you might have tips coming in. If you're a salesperson, you might get sales commissions or bonuses. If you're a property owner and you're renting that out to people, you can also include your income from rental properties. If you're receiving any child support, any social assistance benefits, income support from relatives, any sort of government GST or HST benefits, so they reimburse you for your taxes. If you have any student loans that pay you on say a monthly or a quarterly basis. If you receive the Canadian Pension Plan, any old age security benefits, earnings on your savings or investments, or withdrawals from the registered retired savings plan. So basically, the first step is find all the income that you're getting, find all the sources from where money's coming in, and identify those and put a number to it so you know generally how much money is going to be coming in on a monthly basis that you can plan around. The second category is your expenses. So for all those mathematicians out there, the general formula for your budget is income minus expenses ends up being the either savings that you have at the end of the month or the sort of overspending that you find yourself in. So the expenses can include anything almost that you spend money on, but they usually fall into about 4 categories. So the first is housing. And each of these categories is typically just because we're all people and we have things that need to be paid for, and we all have basic needs. We all have basic needs. So housing, that can include your rent or your mortgage. You might have to pay to heat your home. You have to pay for electricity. You might not have cable, but most people have internet now, cell phone, home phone if you still have one. And other expenses related to that. So insurance, any property taxes, any maintenance on your home. Basically all that can be somewhat like grouped together and put into your housing category. Your transportation category, so everyone needs to get around. Maybe not as much now during COVID, but before COVID and once COVID's over, you will still need to get around. And I'm sure some of you are still working now or still traveling for whatever reason that might be. So if you have costs associated to your car, so the loan for it, the lease for it, the repairs on it, the insurance, any gas and parking, and again, the insurance on your car. And if any of you are taking public transit, you might need a Metro Pass, TTC card, bus tickets, tokens, whatever they might be. You need to include that, how much you're spending on a weekly and monthly basis, and add that to the category. If you're taking any taxis anywhere, if you're taking any Ubers, or another thing, if you're renting bikes. So I'm not sure if you're all in Toronto, but there is the bike share program in Toronto that you can get a membership to or rent it on the hour. So if that's your preferred method of transportation, to do a general estimate of how much you're spending on that and include it within your transportation category. The living expenses are, again, mostly necessities. So your food, your clothing, if you need to pay for childcare for your children, if you need to make any loan or credit card payments, if you need to buy any prescription drugs, and every other cost that sort of comes with day-to-day living. So that can be any pet supplies, so food, or I guess toys, any laundry, if you need dental insurance. So anything that really comes to you and your daily living habits. And the final category is your personal expenses. So this is basically the things that you're spending money on that are specific to you. The other 3 categories are pretty standard for almost every person, but the personal expenses, again, become pretty personal. So that can be anything you do for recreation or entertainment. So again, my examples are from pre-COVID. So for example, if you're going to the movie theaters, if you're going to bars or anything like that, that would be included in your recreation and entertainment. If you go out to restaurants, again, bars or anything, if you're a smoker, if you enjoy drinking, if you get haircuts, when you get haircuts, not if you're a magazine reader, or if you like to buy books or subscribe to newspapers, and finally, any savings that you might be doing. So again, if you're saving for a vacation or a retirement, or buying a home, even though you're keeping that money yourself, it is still an expense because you're removing that money from the amount that you're sort of able to spend on alternative things. So the best way to do it, there's an old saying, it's to pay yourself first. So when you receive a paycheck, if you have the means to, and you're saving up for something, the best idea is to basically take the amount that you plan on saving and put that away right away. So that can be putting in a savings account, putting it in a registered retirement savings plan, anything along those lines. You want to get that money away and out of sight almost from yourself, because if you do have money sort of lying around, it either gets spent or gives you the false impression that that money is there to be spent. So again, just keep it as an expense and make sure that you're paying yourself first. So let's take it all together. So in order to develop a budget, and the best thing you can do is honestly find a budget template, as I mentioned. So you can rip over to Prosper Canada. It'd be great to be to find one of their budget templates. From there, you'd be able to basically fill out all those previous categories I mentioned. So they basically list it out. It's like how much are you spending on rent, how much is your car payment, how much is gas, all that. And you're basically just going to be filling in the numbers. So that's probably the easiest way. But again, you can find them on Excel. You can find a budget template anywhere, or you can just follow the list that I just enumerated. So the first step that you're going to do in terms of making your own budget is to get ready for this process. So that means collecting all the documents you're going to need. So that can be your credit card statement, that can be your bank statement, that can be your paycheck, any government checks or direct deposit slips you get, receipts for everything, and loan documents. So once you have all that together, the next step is to list out all your income. So again, myself, when I do this, it's basically just my paycheck from work. So I put that down as my income. But if you have other sources of income, you basically just list them down and make sure that you have them separated for each different source of income you have. Add them together and you'll find your total monthly income. So how much money are you getting every month that is available to be spent on the expenses? Speaking of expenses, the third step is to basically find all your expenses and list them out into the categories I mentioned. So you're going to want to list their names first, and then again, how much there is in each one. Or if you're taking the shortcut, which I do recommend, you're just going to take the Prosper Canada budget template, and you're just going to follow the list down. You're going to add the dollar amount for each of those expenses they list. Following that, you're going to do the math. So it's pretty quick. If you have a cell phone with a calculator app on it, if you have access to the computer, as I hope most of you do because you're at this webinar, you can quickly do the math if that's not your strong suit. You basically add up your total monthly expenses, so how much money is flowing out every month, and you'll subtract that number from your monthly income. And then you'll see whether or not you have money left over. If you do, then you can either save that, treat yourself to a nice meal, a bottle of wine, anything like that. But if you're spending more than you earn, then you're going to have to, look at the expenses and just determine which are going to be the expenses that you're going to try your best to limit. So usually those come from the personal expenses. So for example, if you're spending $40 a month on books and you're $40 a month over on your budget, you can cut out the purchasing of books and try to find alternatives. Try not to just cut them out of your life, because they still do bring you joy and happiness. And those are still very important for people to keep in their sight. So if you are a reader, for example, it might be a good option to look at a library card and to, borrow your books from the library. But really, it really comes down to your situation and what you find yourself in. And if you're at all possible, try to find yourself in the position where there's money left over at the end of the month, as opposed to being in the red. And finally, you got to revise your budget. So you have to revise that not every month, because it can be a tedious process. But if you want a good idea of everything on your budget, then you just revise it every month. But I do recommend every 2 or 3 months to take a look and make sure that you're at least on track and that numbers haven't changed drastically. You want to make sure that you're looking at it honestly and realistically. So what can you actually cut back on from those expenses that you listed? In terms of some budgeting tips, the best one I can remind you of is to remember your goals. So you can write those down, you can put them on the fridge, you can make them the background of your phone, anything like that. But whatever that goal is, say it's a vacation or buying a car or paying off your debt, whatever it is, the best thing to do is to remind yourself of that often, so that you're not sort of led off track. The second is to be realistic. So if you put down a goal of saving $10,000 a month and that's not something you can actually do, then it's better to recommend that you're going to save $100 a month, for example. So really be realistic in what you're able to really cut out of your life and to budget around. Keep it simple, so try your best to make sure that you're not overthinking things, that you're just sort of trying to keep things as simple as possible. Keep a record, so any receipts you have, any credit card statements you have, keep those around from when you make your first budget to the next budget you have, to see if things are changing and see if your habits are actually, your new habits are following what you'd like to do. Stay organized. So again, make sure that you're keeping you're staying organized, making sure you know when different bills have to be paid. Use your bank to help you manage your money. So you can open several different accounts at a bank. Some of them might be free. So if you want to have a saving, well, if you are planning on saving money for something, you can have a savings account at your bank and you just transfer the money from one, so usually your checking account, over to your savings account so that you know it's separated and it's for a specific goal of yours. Please include your debt and your savings into your budget. Again, some people forget to do that, and you do have to pay your debts if you have them, and you want to make sure that you're including savings in your budget so that you are actually putting that money aside and not sort of treating yourself with money that you told yourself you would be saving. There's a paycheck plan. You have to plan for changes. So everything changes every year. For example, well, every month almost, especially in Canada, your hydro bill and your heating bill is probably going to be higher in the winter than it is in the summer, or at least the spring. You might need air conditioning in the summer. But really be flexible with yourself. Don't be too hard on yourself, but try your best to stick with the goals that you put together. You got to be patient. Like, financial discipline doesn't come overnight. It's not an easy task, but if it's something that you want to achieve and you have the means to achieve, it definitely is something you can work towards. But again, it won't usually happen overnight. And finally, look for support. So a lot of the information that I covered tonight did come from Prosper Canada, as I mentioned at the beginning. They're a great resource. If you have any, questions, or if you're looking for additional resources following this presentation, they're probably one of the best options. But there's plenty of financial advice out there. Try to be discerning about who you're looking to for financial resources. Usually I can recommend, if it's a registered charity in Canada, they're a legitimate organization that has your best interest at heart. So typically look for a registered charity in terms of offering you financial advice on your debt payments and your savings plan. But that summarizes it. I know that was a lot to just listen to someone speak for 50 minutes, but thank you all very much for your patience. We'll open it up for questions now. Again, thank you all so much. Happy New Year to everyone. I forgot to say that at the beginning. But I hope that this was of use and of interest to you. And yeah, thank you so much, everyone. We'll open it up for questions now.
Daniel, thanks so much. I always think that the sign of an excellent presentation is the kind of questions you get, and we've started to get some really good questions. So how does it suit you if I read out the questions and let you be the expert on the answers? Is that okay?
Yeah, absolutely.
So our first one, how many years of Canadian credit history is normally required when applying for a mortgage? I never had a credit card before coming to Canada.
Yeah, that's a great question. So just for some clarity, I guess, if you, do you have a credit card now that you're in Canada and you're sort of beginning to build one? Okay, so I've just got the chat box open, Kathy. So
perfect.
Yeah, so in using that, it's a good first step. If you're using it, and again, following those best practices, that'll establish your credit history and your credit, well, it'll inform your credit report. It really depends on your situation. I know that like a lot of answers to financial questions are going to be case specific. Usually I would say, again, an estimate, I don't know the exact answer, but they want to have a clear history of you making repayment on your credit card and any other loans you have. It could be anywhere between 3 to 5 years, depending, again, say on your income, any other assets you have, and the overall health of your credit history.
Great. Do you find that places will take into consideration your credit rating from Ireland? I've only been in Canada for over a year, so I don't have a great credit score yet, and I'm looking to get finance on a car.
Yeah, great question. Unfortunately, I'll be the bearer of bad news. Typically, credit agencies and credit bureaus in Canada do not look at your credit history from outside of the country. The reason for that is that unless there's an agreement between the credit bureau based in Canada and the credit bureau in in Ireland in this case, they wouldn't be able to rely on it, even though I'm sure Ireland's a great country, and I'm sure, yeah, Ireland's a great country, and that there's a great banking system in place and it's legitimate credit history. Unless there's an agreement between the bureaus, they will not take it at face value, and you're going to have to basically create your own history in Canada, unfortunately.
But at least we now know how to do that thanks to your presentation. All right, moving on. When paying for utilities or phone bills, should this be done by Interac transfer or pre-authorized payment, or does it make any difference to your credit? That's a fantastic question.
Yeah, that's a great question. So neither of those will actually have an impact on your credit report if it's done through your banking account. So Interac transfer, if it's done through your checking account, because it's not actually accessing any credit, it won't make any, it won't affect your credit report whatsoever. And the same goes for pre-authorized payments. So again, if those are going through your banking account, that's a debit. So it's basically money you already are in possession of that you're using to pay. If you're using a credit card, that's where, the pre-authorized payment on your credit card, again, that's a good practice because you know that those payments are going to be made every month to the utilities or phone provider. But you got to keep an eye on the other end to make sure that your credit card is being paid off on a monthly basis. I hope
that's a good roll into the next question, actually. With respect to building up a good credit score in Canada, should you try to take out a small loan or just consciously buy things on your credit card on a semi-regular basis?
Yeah, that's a great question. So what I would recommend is, so from my job, usually immigrants to Canada can only access a credit card. Usually if they've just arrived, it's a like standard Visa or MasterCard with a what's it called? A limit of up to $1,000. And they're not able to access loans unless they have collateral of some sort. So if that's the situation you find yourself in, or just in general, the best thing to do would probably be to use your credit card for certain expenses, like groceries, for example, that amount to not too much every month so that you can pay it off every time you receive your credit card statement. But it is showing a steady history of you using that credit, using it responsibly, because you're not charging like almost 80% of your available credit. So you're using it responsibly and you're making those payments, and that can be a great way to get off to a great start creating a credit history in
Canada. A question here about Equifax. I had to get a credit rating for my rental apartment prior to moving in. I went onto the Equifax website and managed to get a free one. However, it didn't actually provide me with my credit score. Is this something that should be available to view when obtaining the free credit check twice a year?
That's a good question. Just to confirm, you received the was it sent like snail mail in a physical paper copy of it?
Just wait for the answer there.
Yes, sorry.
No, it was via the website and I printed it.
Typically, they would include your credit score just because that's a pretty important part of your credit sort of portfolio, let's say, or credit history. That is, unfortunately, I'm not able to give too much more context to it just because I'm not sure exactly how it was kind of gone by. But that's a tough one because I believe that you should be able to receive your score with that inquiry.
If you want, I will pop my email in the chat before we finish, and feel free to email that question to me, and I can circle back with Daniel later this week, or I can, we can do a little more digging. So
that would be great.
I'll make sure you guys have my email. Do you have recommendations on who to go to for long-term financial advice? Bank versus fee-only financial advisor?
That's a good question because, so I'm just to kind of clarify, I'm not like any sort of certified financial advisor or planner or anything like that. So I can't give you any specifics on or like any actual recommendations. My personal view on the best place to get financial advice, out of those two options, I would probably say it's kind of tricky because the bank themselves do have a vested interest in you buying their financial products, and a fee-only financial advisor might be a little bit less biased to the individual institutions, like say a TD versus an RBC or something along those lines. But they do have a vested interest in sort of having you come back repeatedly, right? That's their business model.
I don't think, Sophie, we can tell you. I mean, I certainly can't, but I don't even think that Daniel can, just to protect him, can tell you which to go with. That's a personal choice. It's an excellent question, and it's one that we all, I think, scratch our heads over year on year when we look at our statements from those people who are handling our finances. Okay, we have another one here. I now have a credit card for the first time ever. When paying off your credit card, is there any issue with just paying off immediately as you spend so you can keep track of your spending? Oh, I see. As opposed to waiting till the statement comes in at the end of the month.
Yeah, so that is recorded, and that all shows you using it, even if you pay it off immediately. So, like, I have personally gone and tried. Well, I have used both methods. So after I go to spend whatever $100 on groceries, as soon as that shows up on my phone, basically like the app, I'll pay it off right away. Or what I've sort of resorted to now is just waiting for the credit statement, or the card statement, pardon me, to come in and just pay it off all in one go. I find it a little bit more efficient just to make one payment every month. But if you prefer to pay it off sort of on an ongoing basis, then you can absolutely do that. And it does still provide you with the benefits because, again, it shows you're using your credit, but you're paying it off. So it's as good as paying it off on a monthly basis before the due date of that credit card statement.
So I have popped, sorry, go ahead, Daniel.
I was just going to say, long story short, there is no real difference in terms of in the view of the credit agencies. You're using your credit card and you're paying it off. So it's basically shown as if you're paying it off before the due date, and it's viewed the same way. It's really what your personal preference is.
Well, that seems to be the end of the questions. Folks, I have to say thank you very much. Those were terrific questions, and we appreciate it when people do ask, because chances are we're all sitting here with a very similar question. So we really appreciate your participation. And I would like to thank Daniel so very much, and Windmill for lending you to us tonight. It was a terrific presentation, and I learned a lot. There were some really good tips in there. This, folks, has been recorded, so if you have friends who missed it, reach out to us and we'll make sure that you can get access to it. And I will wish you all a lovely evening. Daniel, thank you.
Thank you, Kathy. It was my pleasure, and thank you all for your patience and great questions. I hope you guys have a wonderful rest of the night, and well, best of luck.
Bye, folks.